Hello, I'm Natalie MacDonald and you're watching Sydney Direct for all of the very latest goings on the Australian financial markets. Today I caught up with Aaron Lynch at OptionsXpress to give us a little commodities overview. Aaron Lynch, thank you so much for taking the time to chat with Dukascopy TV today. Always a pleasure to catch up with you.
And lovely to see you as well, Natalie.
Okay, so let's talk commodities then. And US oil did slip to fresh lows this week. It started off as an oversupply issue and has kind of graduated into a Greece and China issue, much as everything else at the moment. But really, what is that key market driver in your view?
Well, look, we had our recoveries throughout the year and that really sort of fought against the fundamentals of oversupply. So we've really been swimming against that stream. So really in the last few weeks, the supply fundamentals have come home to roost in this market. Obviously, we've got the Iranian deal that's hovering on the border, whether or not it will come in or won't come in. And news out this morning says that they're still further away from that. So there is that overtone of oversupply in that market. But obviously, as the Greek situation unfolded and certainly China, it turned into a risk-off environment. And obviously, crude suffered because of that. But strong sell-offs. But interestingly, it's brought it back to quite an interesting technical level. July is a seasonally strong period in the market. If we look at the all-time highs, they happen to be in July. In 2008, if we look in 2006, the all-time tops were at that time were also around this period in July. So it does produce seasonally quite active periods for particularly crude oil.
With none of these issues, though, likely to resolve anytime soon, can we see this sort of low commodity price environment going on for the medium, perhaps even the longer term?
Look, I think so. I think, the new normal in terms of where we're heading. So lower commodity prices, I think, is definitely in the global growth environment an expectation moving forward. Of course, there's always price shocks, and they're essentially geopolitical and probably US dollar related shocks that could hit the market. But in terms of global growth, obviously they're talking about China trying to hit that 7% number. As we know, with figures out of China, they're essentially what they need to be as far as how the numbers come about. A lot of people claiming that growth is nowhere near 7% at the moment. So given that they are the main driver there, it's hard to imagine that we're going to see some immaculate rally back to record highs in these in commodity prices. But that being said, being the asset class that they are, they always react very chaotically when we see similar news that we've seen this week. So for whatever reason, we could see some shocks to the upside, but unlikely in the near term.
You mentioned it there, but is this low price, sort of high volume environment Australia's new normal? And similarly, if so, how is this likely to impact perhaps some of the smaller Australian mines?
Look, we're seeing essentially the life cycle of commodity-based businesses. We saw in 2007, 2008 as prices were hitting record highs. We saw not enough supply hitting the market. So then everybody decides now that they need to open a mine or start to, produce these commodities. And of course, that investment always comes late. And we're seeing that investment hangover or boom hangover still sort of driving the Australian market. But certainly, as we know, that's starting to plateau. This I really see as the next phase, which is high cost producers are now being squeezed out by their low-cost rivals. And so in an environment where prices are significantly lower, it all becomes about market share. So now we see the likes of Rio, BHP, Vale, in particular in, say, the iron ore space, they're very happy to see those higher-cost mid-tier producers disappear, and they'll continue to ramp up their supply to force their business case. So it's really a maturing of the commodity cycle in terms of the business investment cycle and where we see supply and demand. But it's nothing new. There's certainly not any different to any of the other commodity cycles we've probably seen over the last 100 years.
We've touched on China already, but this stock rout is really kind of creating ripple effects sort of across the commodity sector. As the major importer for, pretty much every resource material there is, which resource sector is kind of likely to feel this the most?
Look, there's a number that are of a concern. Look, iron ore is one, which is easy to see that's going to be a difficult road moving forward. Coal's another one. Coal's been absolutely belted. Some of the other precious metals, not so much your gold and silver, but your platinum and palladiums have also come under a lot of pressure recently. And of course, the demand for natural gas and crude oil are always, top of mind. But if you look at the better performance performers. I think high-grade copper probably has a better outlook, particularly into 18 months, 2 years away. The supply side of that equation looks a whole lot better. But if you're talking about where the pressure will be, it really comes down to policy decisions out of China. They want to see their local businesses thrive, and so it'll depend on how much protection they want to throw in to see local iron ore and coal producers survive over there. And it'll really come down to their policy settings. But certainly it'll be a tight road for the likes of iron ore and coal in particular over the next 12 months.
Aaron, thank you so much. Always great to get your comments.
Pleasure. Thanks, Natalie.
For more commodities updates and analysis, why not take a look at our Commodities Corner interviews on the Dukascopy TV website. For now, it's goodbye from me.